Hi everyone, welcome to our webinar series. Um, I don't know if you can hear. So, just welcome to our webinar series on Thrive. It's helping you thrive in your business, basically. So this week's one, month, because we're doing it monthly, uh, is boost your business wealth, and it's basically how you can boost your business wealth. It'll be looking at things that are accounting based, which is your balance sheet, but we're talking about more how you can look at it, what's really useful to look at, and everything like that. So let's move forward. So very quickly, listen to me. I am the MD of Naylor Accountancy Services, which we've grown since 2011. So we started end of 2011. And then we've also, I started intelligent outsourcing, which is another business in 2016. So I do have an idea of how to grow businesses and everything. So we've grown it to 100 and we're looking to grow more than that. So the core purpose of Naylor Accountancy Services is to be your partner in finance. So that's to be someone that you can go to and talk to about finance matters. And it's also helping businesses thrive. So that means having services and also having these webinars and things that enable business owners like yourself to be able to pick up ideas that will help you thrive. And also we can actually help with services that we do as well. So helping businesses grow. Some businesses don't want to grow, but you might want to be more profitable. So you might want to be looking at how you get more efficient in everything that you do. We're introducing something called Profit First because we've just been certified Profit First accountants and professionals. So we'll be looking at more in that as well as the months go on. We use technology to make your life easy. We've always done that since I started in 2011. So we started with Xero. Now we use Xero and QuickBooks. So we keep growing with what we do to make your life easier and use technology that can actually help us keep an eye on you as well. And we help get what you want out of the business. So that can be, and you need to think about what you want out of your business because not all business owners actually think about this. So the main thing there is thinking about what you want from the business, the financial, time and mind, and things like that. So just bear with me 1 minute. So then we move on to the next slide, webinar. So this webinar is boost your business as well. We have a load of other ones as well. So coming up, we've also had some as well. They are available on our YouTube channel, the Naylor Accountancy Services YouTube channel. So if you want to have a look there, do go on and have a look. So this is it. We're going to be reclaiming your time next, which I think is such an important thing for anybody, business owner or not, but it's very, very important. Then it'll be 10 hats, the core values, the business continuity planning and cash flow freedom. So it'll be those that what we'll be doing the next few months. If you want to see the whole list of our websites, go to events, and you can go down into event webinars there. For the day, always start with thought for the day. For me, that's so important. And with that, what it is, it's the secret of change is to focus all of your energy, not fighting the old, but building the new. So the secret of change is to focus all of your energy, not fighting the old, but building the new. So don't fight the old, but build the new. So it is the next session is huge as well. And that's the same as basically building a sheet effectively, which and a clear view on in sheet and how you can actually make sure that it works for you and boost your business wealth basically. But before we get stuck in, just need to just throw in some disclaimer. This is information that's educational webinar only. It's no substitute for the real thing, like a tailored advice and specific practical circumstances that your business might have. So just as a disclaimer. So we'll talk about the balance sheet, which is your and show you how that relates to your business wealth. The story that it tells you about anybody's business, basically, and discuss just some of the practical and proven strategies for building a stronger balance sheet, which then effectively is boosting your business wealth. So that's how that works. We'll also cover the 4 most important areas of focus, that the way to maximize, and then practice tips, and then as well as what the next steps are, how we can help. And then there'll be Q&As at the end as well. So if you've got any questions, write them down and let me know. I would also take notes throughout this. So if you've got anything that you see, or I might do something about that, do that as well. Thank you. So, I hadn't seen it. So this is basically what we're going to be doing. So I've just been talking through this. So I've just been talking about. So, and your next steps. So, and how we can help. So this is the whole process that we'll be going through. So that's the agenda. It's good to have an agenda, obviously, so you know where we're going, and then you can see what's useful to you. If you're watching this on YouTube, on the video playback, you can see here what we are doing, and you can also just skip to those areas that you are more interested in, but it is worth seeing the whole thing through so you understand where everything is fitting in. So it's time to talk about the balance sheet. So most business owners look at the profit and loss, and that's what we always look at. To be fair, that's what I was looking at mainly to start with, and still, but you really must look at your P&L. So you always think of, looking to drive up revenue and drive costs down, but you also need to look at what's happening underneath the bonnet, which is effectively your balance sheet. So it is important, the P&L, but the balance sheet is really key to focus on to get a profitable business that can just make sure it's stable and won't go broke. So profitable business can go broke, and that might be because they've not got enough cash and things like that, but we'll go into that more. So you might not have great systems for invoicing, so you might forget to invoice. Now, I did an acquisition of an accountancy firm that did not invoice for work they did. So when we were doing it, there was work they did a year ago, and they were stressed because they were working really long hours and everything, but they weren't invoicing for the work they did. So they're getting no money coming in for the work they were doing and getting stressed about. So in reality, you must have a good invoicing system, and you must then collect money. So we did another acquisition just recently, and there was an issue collecting the money, because then I had an issue with Naylor Accountancy Service. This is an acquisition for Naylor Accountancy Services. I had a problem with Naylor Accountancy Service paying salary. And all the outgoing salaries is the main one for any accountancy firm, because obviously they're high salaries and you need a lot of people. So that was a problem. So we had to really focus on, we did have a good system, but we had to make it even more robust for the new acquisition, because they were operating on a different way. So we had to get them in and then just make the things better. We have something called Project Perfect in Naylor Accountancy Services. And whenever there's something that is slightly going wrong, we put it in as an issue, we discuss it, and we create a solution, add it into the process, make sure everybody knows that it's doing that process. So going forward, it's exactly working how we want it to. Cash is the auction of the business. So if you don't have your cash, you can't pay what's due. And the balance sheet is where the cash actually is measured. So you see that in the balance sheet. So that's why we talk about the balance sheet boosting your wealth. And there's calculations and ratios that you can do using that and you look at your debtors and your stock in progress. That's all on your balance sheets too. Bankers, if you want a loan or credit rating, they always look at your balance sheet. If you're limited company, you're at company's house, the minimum you'll have is a balance sheet, and that's seen by everybody, and it's also scraped by all the credit rating agencies plus other stuff that they have as well. So it's really good to be solvent, and that we're talking into that more. There's a big test on the balance sheet that people do, an easy one at a glance to see if the business is solvent. In a downturn, it's even more important to be careful and make sure that as a business owner, a director, you're not drawing too much money, because people do draw far too much money, and tax bills are generally sort of lag what's going on as well. So that's one thing that happens. So we need to make sure that you don't do that too much. And a personal budget update is sort of strongly recommended, just because then you can look at what you are drawing out of the business. So if you look at, this is a bit of a profit first thing as well. So if you look at what you're drawing out of the business, make sure you have enough funds in there for everything that you've got going out of the business, and then draw out from there. And then you have like a pot that you can draw out, which you know everything else is covered. But I'm not going to say, just a bit like a war chest of cash. And that is sort of essential if there ever is a downturn, like COVID. That was a big issue. We've had the sort of the living crisis, the inflation issues that we've had. So you want to be a little bit careful there. Make sure you've got enough funds to weather any storm. Like I said, we've just become Profit First certified, and that's a lot to do with all this as well, looking at everything like that. So we will be doing that as well. So I'm just putting this in as well. So we have got tests here that we want to be doing, like the acidity test is a test for survival. So that's one thing. Strong balance sheet, it just can weather most storms. So now that you know why we need to focus on the balance sheet, let's just talk about what it actually tells us, because it's not straightforward. Obviously, if you are a accountant, it's easier, but it measures your net worth at so basically that's a very good thing that it does do. So it measures your net worth, and the statement of position provide sort of a snapshot for the business at that position. It measures the net worth of your business, well, solvent or not. And that's another big thing. So it shows if you're insolvent and you don't have enough cash available to pay your VAT bill, basically. So because your VAT is a liability, so that'll be against you on your balance sheet. And then your cash is a positive. But then, and we add debtors and everything, people that owe you money, they're positives, but obviously you haven't got the cash to pay your VAT. So that's all in there. So you'll be looking at that you are solvent and you have a positive net asset, basically. And you can compare periods. So it also sort of provides the basis to calculate key ratios like debtor days, inventory days, and working capital. So let's just look at a few examples just to give you, and it is basically a useful strength for the business, and it's a basis calculating ratios, like I've just said. So let's look at some examples here. So imagine you've got a building company, yeah, and the balance sheet, you've got the owners, they've got earnings here. So you can see here the net equity, the current earnings is a negative for, we're using 2020, which means they've made a loss. So in that year, and it's gone down. So the balance sheet overall has gone down. Total equity has gone from 47 to 2,000. So with that, return earnings, just from the prior years, have just been eroded. So it means it's going down. If you're looking at it on a credit control perspective, a credit rating agency perspective, it's still okay because you're still positive, but you've got less strength there basically on the balance sheet. So if you then look at the current account, so this is cash. So you've got now, and you've got very little, £11. Very little at 2019, but you've got very little, even less now. And income tax received. So you've actually received cash because you made a loss in the year. So this is like corporation tax. You've got corporation tax back from a refund, basically. So it says income tax is actually corporation tax for the UK. So that looks, you're okay, but it's not great. You have got cash coming back and the tax back as well. Stock in hand, you've got a lot more stock in hand straight away. So that means that you're not, your cash is tied up in the stock. You didn't have as much in 2019. So that means you're not selling it and you're buying it too quick. So that doesn't look, it's an asset, but you've got to get rid of it. So that is an issue that you've got. Work in progress, that has gone down. So that means you don't you've invoicing for most stuff, but it might mean there's much work coming in as well. But that's another thing to just be looking at there. Then here you've got, this is the shareholder amounts, that's the same as a director's loan. So your director's loan account has gone up. So you actually, the director of this building company is taking too much money out, and they've not got any dividends or available dividends to pay it off. So what they should be looking at is taking less out and making that more stable. You would be paying tax on this in the UK if you don't pay it back in 9 months. And you do get it back, but it's a pain to get back, and it's not a very good one. So you want to be, people will be looking at this as well on your balance sheet. So they're just taking more cash, like I've said. Receivables, so that's the debtor days is 48 in this. So what how you do that, it's been reduced to 82, which is good. So it's got less, but that might be because they're not getting as much money coming in. But it's a 48 days, and if payment terms are 7 days, that there's sort of a significant amount of cash tied up here, basically, which is now, those debtor days are worked out with all the formula. I won't go into it too much here, but there are formula that you do that create that debtor days. Non-current assets, that's basically dropping total non-current assets, dropping value, and that sort of indicates that fixed assets are due for replacement. So you've got that, because the reason why you've got that, you're thinking that anyway, is because of your plant and machinery is going down in value. The depreciations keeps going. So what that means is you might need to replace some of the plant and machinery. You need to make sure you've got some cash there. You may not. It may depends on the lifetime of the actual machinery and plant or whatever it is you have, and your depreciation. But that's something that you need to be aware of when you see this on a balance sheet. Then you have the total assets. So total assets have gone down, but not sort of significantly. But if we exclude sort of the overdrawn shareholding account, so that's the loan. So if you ignore that, then the assets reduced, by almost 40. But you have to take that into account as well. So you've got to be very careful with your director's loan. Something we speak to clients about all the time. Just be very aware of overdrawing yourself. So we like people to have a conversation with us if they are thinking of taking funds out. This is the bank. So these are liabilities. So this is loans. So we have here, an overdraft here that's still there, and the Visa, and so we've got core overdraft, refinancing. So you'd want to refinance the 3,000 into a loan, just because normally on a Visa card you'd be paying a lot more interest. There's no point paying too much. Put it into a loan. So do something there. VAT. So the VAT here, there's no corporation tax. So that's this income tax line thing here, because you've made a loss. You've got money back. So there's no. But a good strategy to preserve cash is just to put aside, and we say this to everyone, and it's a very good profit first thing. Create an account that's called a VAT account, tax account. Put a percentage away, which we say is between 18, 20, it all depends on the business. 18, 20%, obviously 20% is it. But if you put 20%, you're more than okay. Of all your revenue coming in, that cash you get in, put it in there, and then you'll have enough for your VAT. But it all depends. It can be anything 18, 20% as the max, but that's only if you have very little cost that you can reclaim back. But you should be putting something away just so that you can pay your VAT, because you are actually just acting as the HMRC's VAT tax collector for them. So there's a loan here on the phone. Again, any hire purchase or anything like that on a phone, they're normally quite high financing. So you might be better, instead of having a loan on the phone, in this case, you might be better getting a loan out from the bank and having it on the normal bank loan, because financing on things like that tends to be higher. And here you've got trade and other payables. This is people that you're paying. Now that's gone up massively. That means you aren't paying your bills on time, this building company isn't. What that means is that he hasn't got enough cash. If I was looking at it from a bank perspective or anyone else, I'd be concerned, or even a supplier, you aren't going to be paying me quickly because you actually owe a lot of money and you're not paying it. So it has changed an average to 74 days to apply it it's now 74 days for you to pay, or this building company to pay, whereas the previous year it was 47. So it's just, this is an issue that you need to be looking at if you've got that. And the only way you can actually do any of that is make sure you've got cash set aside for a rainy day if you've got problems in the business, which is one thing that is creating a better, healthier and wealthier business, basically. So we've covered quite a bit there, but so here I've just got the loans. These are the different loans here that we've got. So you could do some balancing the loan 70 with loan 71. That was sort of done there. So there's a refinancing going on, and just be mindful. Interest cost. It may be because there's a lower interest rate here, which is what you want to be doing. So move everything into a lower rate interest loan if you can. Obviously with COVID, there's the bounce back loan, which were the lowest. So if you've still got them, you'll be paying them over time at low rate, which is fine to have. The net assets of only 2,800. Now that means that is the ability. There's no really ability for this building company to borrow further funds, and because it fails the second test of solvency, which is always to have assets greater than liabilities. So you'd always want to have assets greater than liabilities, just about, but not quite. So with the reduction of net assets, by over 45k, so we need to be thinking about how we can bolster the balance sheet and reduce risk in this case, basically. Strategies here. There are many sort of proven ways, and what we're going to do is focus on what you can control and adapt practical and proven strategies just to bolster your balance sheet, basically. So there's 4 areas. So here you've got focus on increasing profitability. That's a big one straight away, which is sort of incredibly important in any business climate, especially in a bad one. Second one is cash flow. So just improving that cash flow. There's a number of ways we can look at this, and we'll just cover those shortly. Solvency. So just focusing on that solvency so that you can pay your debts as they fall due. And that's one thing we've said about, what I've just said about having that business bank account for VAT, and then director's loan account. So with a director's loan account, that's basically one thing that you want to be looking at. Don't draw as much, just relook at your own personal finance. Can you draw less? We've had this with a client and they've done an amazing job at lowering it, paying off all their debts, and now they're keeping it at a minimum. What we'll be then looking at is once a quarter, they'll be able to take, we can say, well, this is sort of looks good, this pot here, but we want you to, we'll call it profit pot. And then you can take half of that if you want out of the business, leave another half just to build up that treasure chest, basically, for a rainy day that you don't know, assets that you need to repurchase if your suppliers are late in paying, anything like that. So the first strategy of we're going to focus on 7 ways basically to grow your business. The first of the 4 is profitability. So profitability is the big one. So the big one there is increased customer retention. So build a plan to make sure that you wow and delight your clients. So it's one big thing people say is under promise and over deliver. So then people are wowed and working with you. Generate more leads. The more leads you have, the more conversions you have, and then you'll be looking at converting those more of those prospects as well. But even if you don't even if you don't convert the prospects, if you've increased the number of leads and just do the same conversion that you normally do, you'll still be increasing. If you then, and so there's if you can do both, that's amazing. But increase transaction value, and you can do that by offering more valuable services or products, or added service products that will help their business, or whatever if it's an end customer, will help them in their household to have a better, save time, feel less stressed, or whatever it is that your product offering or service is. And then transaction frequency, so the number of times that people are needing your services, buying your product for you, anything like that. And so that's a big one. So reduce your variable cost as well is a big one. So identify and eliminate wastage and rework. So don't, and that's one reason why I have Project Perfect. So if you see anything that's going wrong, you look at what it is that went wrong, why it went wrong. Because if something goes wrong, you spend more time trying to fix it. The other thing it does is, if we can create, we don't have any issues. Everything goes smoother going forward, which means we are more likely to wow our clients and make sure that you guys actually see what we are doing, and make, or you might not even understand what we're doing because we're underneath the iceberg a lot. You just see the top end, but everything's running smoothly underneath. Also, you might just want to renegotiate better pricing on suppliers. That's one thing that you could do as well. Reduce overheads or fixed costs. So review at least annually this, and just getting your best deals on everything and what you wanted to do. And you might want to downsize your office. That's a big thing at the moment, obviously, with people working from home and everything, and not needing big offices. I know my wife's business in London's done this, so they've relinquished massive leases in London because they don't need them. So they've downsized or got less offices now. But seriously, just go through and see what costs that you could cut basically, or you don't need, and see. But you can do that with us if you want, see us as a strategic partner, so we're helping you run a better business, and we'd actually love to work with you more. And that's how we are looking at us helping businesses thrive, by working with our clients, our businesses, and business owners, to make sure that they can actually get more from their businesses and in profit, and free up their time as well. So it is identifying strategies and everything like that in here. And we do have services to do that as well. Improving cash flow. So that is a big one. I've done a whole webinar on this, so I'm not going to go into it in loads of detail, but there's the cash flow conversion side. So you buy a stock, you pay a supplier 35 days, that's cash going out straight away. And then day 65, you sell to a customer. So you're holding it there. We've got 65 days, but 35 there. So you've got holding it there. But then you don't receive payment from your customer until 45 days later. So after you've sold it. So you have quite a bit of time here that you're holding on to that stock. And this is called the cash conversion cycle of 75 days. You've got it here. So there's the calculation. So you have your 65 days until you sell it, plus 45 days until the actual customer pays. And minus the 35 days that you don't pay your supplier, because that's days that you don't need to pay out cash. And that gives you 75 days from when you pay out cash, effectively, your business, to getting the money in. So you have a cash conversion there. So hopefully you know what that means. And do you know what yours is? That's a really good thing to understand, your cash conversion cycle, because if you can make that, compress it more, you have a better cash flow, basically, to make sure that you've got that cash running in your business. So the components of the cash, cash, they always say, is king. That's the main one. We want the cash conversion cycle to be as short as possible, like I say. And the more cash you have in your business, the stronger it will be, and it can weather downturns effectively and pay out all your VAT and everything like that. So, however, the higher your debtors, then you are at more risk. So you can negotiate better terms also with the suppliers. So that's all here. So you can sort of make it work better. Yeah. You've got inventory or work in progress days. So that's basically how long it takes your debtors to pay you, which is what we sort of just talked about there earlier in the credit cycle. So the systemized just the process of credit control, and also have a credit control manager. We can help with this because we've done it loads. We actually do credit control for some of our clients. Have a look what we do, just to get the process, think what you can do, how you can operate it, make sure it's done, get someone else to do it and follow up and chase. If you've got zero on QuickBooks, you can easily send out statements, and also picking up the phone occasionally is a very good one if someone isn't paying. That's the debtor days, sorry, there. So let's look at some key ratios. So of this building basically company. So the key ratios here, you've got formula for stock. This is basically the inventory is taking 38 days to sell. So this is what you've got here: stock over the cost of sales times 365. The 365 is the number of days in a year. So that gives you 38. It was 15, so it's got worse. So it's got a lot worse. Then you've got here frees up the cash. So this is basically reduced by 9 days, so we can free up £13,503 basically. So if we can reduce that formula, effectively the inventory, how long it takes the inventory to get paid, then we'll actually free up 13 grand. So it's quite significant if you look at this and you just look at formulas or ways of doing it within your business to free up the cash, and that'll give you more cash, and you don't have the problems of running out of cash. So work in progress, that's another one. So with the work in progress, you've got here you've got work in progress over cost of sales times 365, and that's 10. It was 41 and now it's 10. So with that, you have so a work in progress taking 10 days to invoice, which is much faster than last year. So it's actually a good thing. So it's only taking 10 days. So it's a good thing. So that's not a bad thing. So reduce if you reduce it by 5 days, it frees up £7,000. So that's 500. So that's actually a good thing. If it was on the other one last year, 25 days, because that, bringing it in line with the 10 or even the 5 that we're looking at doing by reducing that would have released 38,000. So it would have been very worthwhile doing it the previous year. So here you've got the debtors. So the debtor formula. So you've got, where am I? So we've got pretty consistent, between 45 and 48. So that's actually not bad. It's nothing's really changed. But if you reduce this by 18 days, it would free up cash of 31,141. So that's quite significant. So what that means is that we want to get cash in quicker. So if we can do that by 18 days, that will be perfect. Now, your total here of cash. So if you did everything that we said just then, like the increasing everything, you would all of a sudden get, it would have been cash that you'd free up by reducing inventory days, work in progress, and debtor days. We'd free up 52k. It would have been or 92k last year. So you can see it's worth looking at this and having a plan and understanding what the impact is of that. Here, the formula here. So we want to reducing this payables over cost of sales. So at 30 days. So it takes currently 74 days to pay suppliers. which isn't really sustainable. That's quite a long time. So we don't really want to be doing that. You want to do that in any business because the suppliers will get annoyed with you as well. And you may not get as many good deals. You might be paying more as a premium on that as well. So what you'd be looking at doing, if you could go that by 30, that's 34 days, which is more in line, 30 days of payments. That would give an extra cash of 45k, but you'd need that to pay out. We've just done it, we did, which give you 92. So you'd still have extra cash, 47 cash extra to keep within the business. So you can easily do this by doing the strategies that we just spoke about before. The key thing here is it will be a lot less stressful. It's always stressful pay. So here, this is what I've said. So you've got all that work in progress, 52, or it's 7. So I was looking at the other year, so the 19. So you've still got a net cash improvement of 71k, but you're paying your suppliers in a better time, being less stressed and being a better business owner, basically. So obviously, here's that's the net cash. So here we have a recap. So first strategy was to build a more profitable and improved cash flow. And the third one is solvency. So that's the third one. So the first two were profitability and improved cash flow. So we've gone over those. Now it's solvency. So as mentioned previously, we had 2 components of solvency, often referred to the first and second limb, basically. So first, you've got the ability to pay the debts as they fall due, and that's one thing I always look to do, because I hate not paying debts. And also I like to know what cash I've got available in the business. It just means everything is less stressful. You don't waste time with emails from your suppliers asking for payments, because that gets your headspace elsewhere. You want to just be focused on what's happening. So direct debits are great because it just happens. And then the second part of the test is ensuring total assets are greater than total liabilities and not. So that's the big thing that we want to be looking at. So let's look at. Have I gone? Oh, I need to go forward. So let's look at this again. So we're going to look at the current assets and the current liabilities on the balance sheet, and we're looking at current ratios, because that tells us if you're able to pay your debts as they fall due. So if you take, which is in yellow, and put it under the current liabilities, which is the yellow one below. So the liabilities is what you need to pay. Your current assets is what you've got available. Obviously, if you look at here, you've got your director's loan, which is your shareholders advanced account. That is an issue because that's you as a director. So the business is fine because it can come and get that money from you. But if you only get your income from your business, unless you take it out of the business or get a bank loan personally. So just bear that in mind. In this case, yes, it is an asset, current asset to the business, but it is you as well. So that is an issue. So the current ratio here is 1.3 and 1.55 in 2019. So in 2020, what that means is that you have £1 of current assets for every £1 of current liabilities. So you've got more money than you need to pay, but it does include your director's loan account. And in 2019, it was £1.55 you had for every £1 you owed. Now, again, this is director's loan account, shareholders advancement here. So that does need paying back. There we do need, and so you need to be the person would need to be taking less out or pay money back. If we look at this here, the current ratio, if you take it out, is 0.92, which is what I was just talking about. So that means you actually only have 92 pence for every £1 you owe. And that means you've got less cash than you need to be paying out. So there's a problem. So that's what I was talking about earlier, and you can see it here on the current ratio straight away. Now, solvency assets greater than liabilities. So net assets are the total assets less total liabilities, and these look positive. So that's good. However, it excludes the overdrawn director's loan account, which we just spoke about here, there. So which is 64k. So if you add that in, you will you'd need to inject 64k. The company needs a short-term cash injection, basically, because it's in. So that means it's insolvent by 64k. Sorry, if you take that into account. So it would need an injection of, say, 66, or 70k. It would be best, just to make sure that it is all clear. So here you've got a bank loan. You'd inject 70k there, and you'd obviously then you'd get a capital, a positive net asset at your director's loan. So your director's loan is very key. Something that we do talk to our clients a lot about is your director's loan. Don't take too much out. If you come on us with a profit first work that we do, then we would actually be looking at every quarter. You just take your normal salary and stuff, take a tiny bit that we know that you can take out, and then every quarter would be an extra bonus. Basically, if you can't take it out, you cannot take it out. You would leave it in the business, and you need to make sure that you do whatever you can in your business, and we can help you with that. So make sure you are more efficient, getting more business, and making sure that you actually getting the what you need for your living that you want and lifestyle that you want. But don't live your lifestyle if your business cannot afford to pay you what you want, because you do owe it. Once, and we do say this, is that if you go insolvent and you owe the business money, the insolvency practitioner can come after you to pay off any of the company's debt, and they'll come for all your personal stuff as well, because you are owing the business money, basically. So you are a debtor, a creditor to the business. So you do actually owe that. So be aware of that as a business owner. So here we just that. So if you did sort of change it here, you can see that would be, they'd go 0. You'd pay it all off there through there, and then you'd just be in a lot better position. So still needs the previous strategies to increase profitability and cash. So you still do those, but at least sort of the 2 limbs of solvency test are now satisfied. So you're net, and you paying back that 70k, you'll be absolutely fine. Strategy 4 is managing director's loan. This is what I've been talking about a bit here. So just avoid, I've been talking into this a lot, so I don't want to over egg it, but avoid overdrawn balances. It is better not to overdraw, but you will have some livings that you want to do. We can look at that and just, this looks okay, any more that you're stretching it a bit, and you might have problems paying it back in the future. Like I said, with the receiver liquidator, you've got a problem. So do revisit your personal budget, look at what you can do, and just avoid it. Updating your personal budget is quite empowering, and it's having a personal budget is very rewarding. And make sure that if you're not able to live the lifestyle you are wanting out of the business, then have a conversation with us. Can we help make this business work for you better? Stick to regular drawing amounts, which is what I just said. Don't go massively up or down, and secure balances where possible. So wherever you are happy, we happy, you can take the money out and do, but that's like a bonus. But protect the business does go into financial strife and security. You've got to make sure that it is liquid, and not, well, that's like solvent and not insolvent, and that you aren't owing the business money, because you will have to pay that back. Next step. So I've got a huge amount of detail here, and I have actually, my voice has gone a bit, and it is a little bit technical, so I apologize for that. But building and boosting your business wealth is related to balance profitability and stuff. Part of that, you've got your all the fundamentals here that we've spoken about in assessing the business strength, and you've got building profitability. But we've covered that. We've covered improving cash flow. We've covered maintain solvency, and we've covered the director's loan account, managing that, because managing that is really key. These things that we've covered. So what do you want to do next? So don't do nothing, because that isn't an option. It shouldn't be, especially if you have an issue. Put oxygen mask on yourself. That means, make sure that you have planning, more sustainable improvement, and starts always with you as the leaders in the business. You always have to start with you. What do you need to do? Doing a budget for yourself, a plan budget. You need to be looking at things, make that plan, and focus on what you can do and what you are in control of. I always look at that in anything within the business. If there's issues that we've got, what can we control in this problem? We've got a problem. What can we control here? What is out of our control we can't do anything about, but what can we control? And let's control that as much as we can. So focus on what you can do, as I said, worrying about what you can. And then don't forget, we're here to help you. We've got lots of team members with lots of experience, and we've got the whole process and systems in place that nail away to actually help businesses thrive. Or how can we I forgot we had the slide now, but we can help by doing cash flow forecasts. So that can help just plan your cash in and out. Outflows. We did for one client years, and they did a merger with, well, it's more of an acquisition, so we stopped doing it now. But what happened with them was they were going through some problems. We could see it with the cash flow forecast. So the MD saw that there was a problem. We went through it in our review meeting with them, and they actually had to make lots of cuts in people. They meant to make people redundant, but what that meant is the cash out went improved, the cash flow coming in sort of eventually, but it didn't change for a while. What that meant is they were solvent and they could get out, otherwise they would have gone under. And these were a charity type organization as well, so they basically were doing a lot of good, but they had far too many people, and there was not enough income coming in, in order to generate what they were doing. We do have a financial awareness cash management coaching as well. So that's just to help you understand numbers more. We have a balance sheet free checkup. So that's just complete a review of your balance sheet. Just identify where there's improvement. So that's an easy one for you guys that we can do. And we also have complimentary client meetings. This is for Naylor Accountancy Services. And with that, we have a meeting, have a chat, go through everything that you are looking to do, look at what you're doing. We do have free for all of these items. We'd have to complete that, otherwise we can't have these meetings, because we need to know the information before for these meetings to be well worthwhile. We also offer business planning. Now, if you don't do business planning, it's well worth it. And it's what we do once a year, and we review it every quarter for both businesses, Naylor Accountancy Services and Intelligent Outsourcing. So let me open it up to any questions. I don't know if you have any there. I'm going to stop sharing now. Hopefully I can share back in the end as well. So that's what I'm hoping. So any question? So I've got a question here. How can I see my balance sheet? I do have zero. Okay, so if you have zero, it's a very easy, same in QuickBooks, by the way. You go to reports, there's a tab at the top called reports. Go in there, go to the profit and loss and the balance sheet. You've got two reports there. In this one, you go to the balance sheet and you can see your balance sheet and look at your net assets and your net current assets there, and just see if they're positive or negative straight away. If they're negative, then give us a call. Only thing is, you must have your data up to date. So that means all your bookkeeping is done up to date. Now, bookkeeping is key. You've invoiced everything. you've got your bank feeds coming in and you updating them. So if we're doing people's bookkeeping, it's always up to date at least once a week, and we make sure the bank feeds are coming in and everything like that. So make sure that's happening. If you have no idea how to get these reports in Xero QuickBooks, let me know. Just drop me a DM or an email, and what we'll do is we'll look at just someone sending you, or just put it in this chat now, and we'll look at someone sending you just a video of it, because there's lots of videos on how to get to these reports, so you can have a look at that. But key is to have update and accurate data, so make sure your bookkeeping must be up to date. That's the big thing. So any other questions? So current ratios, are they worth reporting monthly? Now, current ratio, the answer to that is yes. So a good current ratio between 1.2 and 2 is what you'd want. So that's how much money you have in order to pay your debt. So if you have 1.2, you've got £1.20 for every pound of debt, or what you have to pay. Yeah. So if you've got 2, you've got £2 for every £1. So you've got double. So you can easily do this, by the way. Xero and QuickBooks do have these ratios built in. So just find the reports for these, and they're actually there. Again, you have to have your data correctly in your, up to date in your QuickBooks, in your Xero, in whatever software you're using for accounting. It must be up to date. And that's why we always say, make sure your bookkeeping's up to date. We do help clients with that. And the reason why that clients want that is so they can focus on the business and not the back office, which is the bookkeeping. But make sure it's up to date. Will we be able to go over the webinar again? No, yes, you can, because I know there's a lot going on here. So by doing that, it'll be on YouTube. So that will come out next week on YouTube, the Nail Accountancy Services channel, and there'll also be you should also receive a webinar email as well. So that's good. The balance sheet health check, what does that entail? So that basically looks at the ratios. So we'll look at that. We'll look at how it looks. We'll ask you questions before. So everything that we do, there would be pre-work that you must do. If you don't, we won't be able to help you, unfortunately, because we do need that beforehand, because it speeds up the whole process of everything. So what would your one action? Sorry, let me read this. What would your one action be? What one action would you take if you were on the webinar? So if I was on this webinar, what action would I have taken up? Everything that I've suggested. I mean, there's lots there, so I'll be looking at most, but the one that I would definitely do, if I wasn't an accountant, is get the balance sheet health check, because it's free. So get the balance sheet health check, get it seen. So you just know where you are and what somebody else who is an accountant knows what it looks like. It's just a good health check. It's always worth doing, just as it'd be good to have your own health check. Okay, we are running out of time. So I hope if you get any other questions, do put them in. But if there aren't, we are probably just going to come to an end in a minute. So I'm just going to pop. I'm hoping that you can see it now. So it's the question. I just a parting thought. I love quotes here. So here's a quote from Harold Janine. So business is many things, at least of which is the balance sheet. If with ever-changing living things, sometimes building to great peaks, sometimes falling to crumbling lumps. So again, business is so many things, the least of which is the balance sheet. So people just don't look at the balance sheet much at all. It is a fluid, ever-changing, living thing, sometimes building to great peaks, lots of cash and credit positives, and sometimes falling and crumbling lumps. And that's why most businesses fail, because they don't have a good balance sheet, and they fail there. So make a simple plan today, commit to at least 3 actions. That's what I'd say, and you will take the results. And you'll get results. But just remember, if you need our support, we are here. Thank you for your support. I hope you've got plenty to make sure this. Take care. Bye. And hope to see you next month.